Hi all, this is Akshara Menon from PMS Bazaar. A warm welcome to all the participants to today's webinar on the topic, The Indian Investor Grows Global, the Gift City Route to World Markets. We are pleased to have Mr. Mihir Shirgaonkar with us to discuss on the benefits of US dollar denominated portfolios, how to participate in today's global trends that will shape tomorrow's ideas, and the seamless investing opportunities available for the gift city. Before moving on to the presentation, let me give a brief introduction of the speaker. As a fund manager at Phillip Ventures IFSC, Mihir manages investment strategies and is proficient in analyzing macro and micro trends across sectors, businesses, regions, and asset classes worldwide. He places utmost importance of the fundamentals of the regions and business in his alternative investments team analysis. Um, Additionally, Meet's skills is in programming languages and visual analytic tools enable the team to drive the insights from large volumes of financial and non-financial data. This approach, combining data-driven capabilities with a strong focus on fundamentals, will help them to gain the perspectives and uncover the potential investment opportunities. The goal is to construct portfolio focused on the trends of today and ideas of tomorrow, investing in businesses and regions with strong fundamental and promising prospects. Regarding his educational qualifications, he has done his MBA from IIM Ahmedabad. He is also a chartered accountant and a CFA holder. Before handing the podium to him, I would request all audience and participants to put the questions in the Q&A box and refrain yourself from asking any stock-specific questions. Over to you, sir.
Thank you so much, Akshara, and thank you so much, everyone, for joining us on this Friday. Very quickly, I will share a presentation. So, the topic for today is going global with your investments and how the gift city route can be effectively leveraged to invest globally. So, I will be covering, of course, about our firm. I'll be making a case for global allocations. I will touch upon our portfolio at some length, our investment philosophy, and then I will also be speaking about our team. So an introduction about us. So we represent the PhillipCapital Group. PhillipCapital Group is headquartered in Singapore, and currently we have more than 4 decades of financial expertise. In fact, in 2025, we will be completing 50 years. We are operational in the financial hubs of more than 15 countries, very prominent in the Southeast Asian part of the world, but also having a very strong presence in the western side of the world as well. So India is one of the largest businesses for the group. Across the globe, as a group, we are servicing more than 1.3 million investors and clients, managing more than $35 billion of assets under management. And we are offering more than 40,000 products across regions. Coming to India, in India, we've had more than 20 years of very strong institutional presence. And our presence in Gift City is the new offering. So our journey in Gift City began around 5 to 6 years back. We are actually one of the earliest entrants into Gift City. Our entire objective is to leverage the Gift City ecosystem and also leverage the expertise which PhillipCapital as a group brings to the table. And in this process, evolve a range of offshore financial market and investment solutions. So we started this journey with our global PMS. We started this fund in January 2022. And currently in our PMS, we are servicing clients across countries. So today, not only resident Indians are investing with us, but even non-resident Indians are also our investors. And this might bring you to a very crucial question that today, if investor is sitting in the Middle East or Africa, why would they come to Gift City in turn to invest into the global markets? So this really speaks about two things because investors are indeed coming. And what it really tells us is the kind of confidence which people have on PhillipCapital as a global asset manager. And it also speaks about the kind of credibility which Gift City is now enjoying in the minds of foreign investors. So we begin the discussion by asking a very critical question that why should we consider global allocations in the first place? Because as a global fund manager, I cannot shy away from the fact that India is expected to be one of the best performing economies in the current decade. Our GDP growth is expected to be much faster than that of the developed economies. And this is the recent World Bank report is also saying this. So why should we invest globally at a time when Indian markets are doing so well? So I begin the discussion with a data set. What you really have in front of you are the local currency returns of some of the largest equity benchmarks. Now, what we can see over here is, so this is a performance of close to 14 years. And what we observe is that there are certain periods in which different nations or different regions across the globe tend to outperform other regions, depending upon the macroeconomic cycle and the business cycle that those nations are in. And here we see that India is one of the best performing benchmarks, no doubt. But at least in the previous decade, what we've seen is that a major chunk of the returns has actually come from the American markets. Now, I did mention to you that these are local currency returns. So when we actually look at the impact of rupee depreciation, I have now taken a longer time frame over here, where of course the Nifty 50 is seen outperforming the S&P 500. But when you actually consider the impact of rupee depreciation, or very simply put, if you are asking a question that how much would an Indian investor make if he or she would have invested in a dollar denominated portfolio of S&P 500, the answer is right in front of you. Currency depreciation alone would have magnified the underlying returns of the S&P 500 by more than 350%. So this is, of course, what has already gone by, the rupee depreciation and the performance of the market. But now, we are in 2024, and when we are looking ahead of us, we really observe as a fund management team and as an investor that there are certain trends which are really shaping up the current decade. I mean, the first trend which all of us can visualize is the kind of grand reset which the COVID-19 pandemic has really brought about. So businesses across the globe have started rethinking their business cycles. There is, considerable diversification of supply chains away from China, and this is actually giving opportunities for a lot of other regions to grow. Like for example, today Mexico is the largest trading partner to the US. By recent data. So that's number one. The second trend is actually something that continues from the previous decade, and that is the kind of technology led disruptions across different businesses and regions. In fact, when we look at the returns of NASDAQ, what we realize is that the markets have actually rewarded those countries, those companies, and those businesses which are actually at the forefront of technology disruptions and innovations. The third trend is again, something which is very difficult to ignore, and that is the kind of inflation that we've seen across economies. While inflation has definitely moderated from its 2022 highs, but the reasonable assumption, given the current environment, is that inflation could actually remain slightly on the higher side all through the current decade, as compared to what was seen in the previous decade. And this will, perhaps open up investable opportunities into a lot of other assets, which are actually considered to be a hedge against inflation. We've really seen gold hit an all-time high very recently. The last point, which is perhaps where our value proposition comes into the picture, is that we realize that there are certain ideas that we believe will drive the next leg of global growth. We are really talking about Industry 4.0, and these are ideas which may or may not be available for investments if you are looking at only the listed Indian equity space. So for us, the debate is never about whether India is a better market or the globe is a better market or the US is a better market. The understanding is that while India continues to be a better performing market, there are certain pockets of opportunities which otherwise may not be accessible if you are looking at only the listed Indian equity space. So we are really talking about some of these businesses of tomorrow. We are talking about artificial intelligence. We are talking about electric vehicles, sustainability, semiconductors, for example. So that is precisely our value proposition. What we really help investors create is what we call as the trends of today and the ideas of tomorrow. I mean, capturing the growth stories across these two points. So with this, I come to the next discussion, which is a deep dive into our current portfolio. So what I have for all of you right now is the Phillip International Pioneer portfolio. This is our flagship product. We've been managing it for more than 2 years now. The entire idea behind this portfolio is to achieve capital appreciation by allocating to various geographies, sectors, and businesses which we believe will grow over the medium to long term. The entire idea is for our investors to capture growth stories across innovations and regional developments. What is very, very peculiar about this product is that we are achieving this objective by investing in equity ETFs. We are not directly investing in stocks, but we are investing in ETFs. Now, why are we, investing in ETFs is something which I will come to towards the latter part of the presentation. But if I really have to summarize our entire investment philosophy, our entire investment research process to you, so it can be summarized into these four pillars. So the first pillar, something which is very, very critical to PhillipCapital as an ecosystem, is a very strong focus on fundamentals. And especially as a global asset manager, it is very critical for our team to understand the nuances of different businesses, different regions, different asset classes. What is the interplay between different factors and how are equity returns getting impacted across geographies? So that is something that we very critically evaluate. The next is what we call as a quant-based approach. So Akshara did mention to you that I have actually been into coding and programming, and so has my team been. So over the past so many months, what we've really done is that we have developed a host of data-driven capabilities in-house. We really call it an information refinery approach, where on a daily basis, huge amounts of volumes are getting churned, and more than 11 to 12 million computations happen at our desk every single day. And these computations essentially help us unlock a lot of insights which may otherwise not be visible to in the normal course of things. And what it really helps us also do is it really helps us to eliminate a lot of noise and really make the process much more scientific. It helps us observe things as they are. The third pillar is a long-term outlook, a very, very important pillar of our process. What we really mean by this long-term outlook approach is that we invest in very, very high conviction ideas across businesses and regions, which we believe will grow over the medium to long term. And to that extent, we do not believe in maintaining a very high churn portfolio. The portfolio churn is very, very limited. We do realize that there are tax implications. We realize that we don't want trading costs to eat up into the returns. So we invest in ideas with the objective of staying invested in them for at least a good 5 to 7 years. Of course, nothing really stops us from exiting a particular investment idea the moment we've invested in it. But that is a very, very exceptional case. We will do it only and only if the fundamental assumptions about a particular theme or a particular business is getting seriously challenged. The last point is seamless implementation. So, we've actually grown with the Gift City ecosystem. As I mentioned to you, that we've operated in an environment where the regulations have evolved. And the direct outcome of this is that what it has really achieved for us is that we have processes which are very, very seamless for investors. We are staying very, very true to Gift City ethos, which is the ease of doing business. A case in point being that for non-resident Indians, there is no PAN card requirement. They don't have to open any bank account. So our investors who are NRIs have directly done a dollar-to-dollar fund transfer into our product without actually having to open bank accounts here. So this itself has ensured that the entire investment process is very, very seamless for them. We support our investors with all the month-end reports, market insights, and a lot of other things. So that has really ensured that there is a very, very seamless flow of information and knowledge when it comes to our investors. So now I come to the next area, which is exchange traded funds. So I did mention to you that in our product, we are investing in US listed ETFs. We are not doing individual stocks or individual bonds. So why did we take this approach? So again, the answer is summarized right in front of you. So normally when we look at the Indian markets, generally ETFs are available only at a broader market level. And then there are some sector-based funds and some smart beta strategies as well. But when we look at the US markets, what we realize is that ETFs are available not only at a broader market level, but they are available also at a sector level. And even within the sector, they are available at a level of specific businesses and specific investment themes. So what I really mean by this is, I did mention to you that there are areas like semiconductors, cloud computing, artificial intelligence. So you have focused products which are giving you exposure only to specific businesses. And like this, out of the 500 plus sector focused funds that we've seen in the US, what we've really found is that we have identified a list of more than 72 investable businesses which can be accessed using only ETFs. So when we are constructing a portfolio, we are simply picking and choosing businesses which we believe will provide substantial upside over the next 3 to 5 years, for example. The next element is a regional exposure. Today, the market for US listed ETF alone gives us access to more than 50 different regions. At our desk, we are monitoring more than 35 different countries. And the reason again is very simple, that if I really want to invest in a China or a Taiwan or let's say Australia, for example, so we don't have to go to the respective stock markets of these countries. We can simply buy a dollar denominated country focused fund which is trading on the American exchanges. So what this achieves for our investor is a dollar denominated portfolio which has exposure to some of the best performing businesses and regions, and that is our value proposition. Today, globally, the market for ETFs is very vast. There are more than 10,000 different ETFs listed on more than 45 plus exchanges globally. In the US alone, we've counted at least 3,500 ETFs. And as a fun statistic, I can tell you that in the last 4 years, okay, starting with 2020, every single trading day, on an average, there has been one new ETF which is available for investments. So there is so much noise, there is so much choice which is available to investors that sometimes it becomes very, very difficult for investors to pick and choose the right product. And that is where our expertise, our value proposition comes into the picture. The entire journey of more than 3,000 ETFs to the final 15 to 20 ETFs that make up a client portfolio are a result of a very, very rigorous risk management process where we are factoring in both fundamental parameters as well as quantitative filters. So with this, I come to the last part of my presentation. I take the opportunity to introduce my team to you. My name is Mihir. I come with more than 9 years of experience in the asset management business. Currently, I manage strategies with a focus on different businesses and geographies. I'm also a volunteer with the CFA Society India as a member of the Public Awareness Committee. In fact, those of you who are regularly following CFA newsletters, you can find my articles featured as cover stories, so you can definitely check them out. Now, I work with two individuals. One is Zaid. So, Zaid manages our corporate strategy, and he has a very strong experience in consulting and deal advisory. In his previous roles, he has worked with a lot of gift city officials on various assignments, and that is the kind of expertise that he brings to the table. And of course, we have Rishwik. So, Rishwik and I manage the global PMS strategy. Rishwik's background is that he has done his MBA from INSEAD Business School in France. For a brief period, he's worked in Europe, and he really has seen some of these emerging investment trends evolve firsthand. Again, Rishwik and I are very, very data driven, and that is the result why we have been able to follow an approach where we are combining fundamental approaches with data driven capabilities. Now, there is an investment committee which sits above us. Investment committee to which all our investment decisions are thoroughly discussed, debated, and deliberated. And only then it is made a part of the investment portfolio. Now, today we also have the global teams of PhillipCapital. So, right now, with the kind of capabilities that we set on, more than 90% of the global investment research is happening in house at our Gift City office. For the remaining 10%, we have the global teams of PhillipCapital. So, analysts across Hong Kong, Singapore. So, anything we require on the global markets, anything we require on the East Asian markets. So, there is a considerable exchange of insights and information with these analysts. And that is how the entire ecosystem is complete for us. That is how investment decisions are made at our end. Decisions which are thoroughly discussed, very, very well reasoned, and they are a product of a very, very scientific process. And that is how we are managing our portfolios. So with this, I come to the end of my rather short presentation. What you see in front of you is how Gift City looks like from our office right now. And it's a very, very exciting space to be. I've been there for the past couple of years, and all I can say that the ecosystem has really evolved quite well. And I think this evolution will only continue further. So with this, over to you, Akshara.
Thank you for that. It was a very short PPT. I must say that. And yeah, when a lot of questions already falling onto the podium. Now more about the gift city and its regulations. To start
Right.
off with, What kind of advantages do you think an investor, both domestic and international investors, could choose if they want to choose this gift city part, apart from any other traditional routes?
So I'll split this into two parts. One is the kind of advantage which institutions have for setting up businesses there. And then, the kind of advantages which investors have, both individual as well as institutions. So first, for businesses being set up in Gift City, I think ease of doing business is very well established because we have a very, very proactive regulator in the form of the International Financial Services Centers Authority. There are industry focused committees which are now being set up, and they really address, the challenges and the queries of businesses in a very, very faster manner. Of course, everyone knows about the tax holidays. So every entity set up in Gift City has a tax exemption of 10 years out of a block of 15 years on their business income. These are some of the advantages. Of course, the infrastructure is coming up very well. These are the advantages of the which institutions are enjoying. Now coming to the investors per se. Again, another advantage that before I forget that there is no GST in Gift City. So again, that is making operational compliances, more seamless. Now coming to investors per se. So again, for investors, if you look at resident Indian investors, now they have their own offshore jurisdiction to invest in the global markets. So today, if they really have to seek investments abroad, they really don't have to go for any offshore funds domiciled in, let's say, Mauritius or Cayman Islands. They have their own gift city ecosystem, which is governed by a completely distinct regulator, which is allowing for investment products and structures so that investors can invest globally. So, that is the first advantage. For foreign investors, the advantage is that they have easy access to Indian asset managers. Instead of coming directly to the Indian markets and then going through a very, very elaborate paperwork, they can directly interface with a gift city fund structure and better access Indian markets in a different way. Third objective is, what we really call as a U-shaped flow, which is foreign investors coming to Gift City in turn to invest in the global markets. So again, this of course there are options available outside, but I think the way asset managers can manage, the kind of differentiated strategies that they have, if they are adopting that in Gift City as well, so even Gift City becomes a very, very attractive investment option for investors. So, these are the advantages which both institutions as well as investors have for looking at Gift City.
Thank you. With that, I'll take a question from the audience. There was one question that said, like, isn't USD expected to depreciate going forward, or at least to appreciate at long-term average at the rate over 4% versus INR?
So I would say that over a short period of time, definitely currency will have its own cycles of ups and downs. Immediately, what we are really looking at is that you have, let's say, the different policy differentials between the US Federal Reserve and the Reserve Bank of India. And if at all there is aggressive rate cuts on the part of US Federal Reserve, for obvious reasons, the US dollar will depreciate relative to the Indian rupee. On the longer period of time, again, if you really look at the interest rate differentials, the inflation differentials, the trend seems to be towards a currency depreciation. What I mean is a rupee depreciation. Of course, I will not say that the rupee will depreciation as sharply as it did, back in 2022, where the rupee lost, close to 11 to 12% relative to the US dollar. So over a period of time, the pace of depreciation could be, fairly lower as compared to what we've seen in the past. So 2.5% around is the historical rupee depreciation. Now it could, perhaps come down to 1 to 1.5%. So that is a trend which we can reasonably expect.
One more question from Sharath is that is the product that you mentioned available only for NRIs or RIs too, or if RI is eligible to do LRS guidelines allowed?
Yes. So this product is available for both resident Indians as well as non-resident Indians. It's available for foreign nationals and foreign institutions as well. For resident Indians, as you very rightly pointed out, because it is essentially getting invested in an offshore jurisdiction, any remittance you make to Gift City will attract the provisions of the LRS. And to that extent, you will have to be cognizant of the LRS limits as well as the 20% TCS, as you would be for any other foreign expenditure.
So the next question is like, how can an Indian domestic investor invest in Phillip Capital in general and Gift City in particular?
So, of course, I mean, we have a very strong presence in the form of Phillip Capital India. So, our head office is in Mumbai. So, we've got a couple of offices there. Of course, all the information is available on our website. You can definitely reach out to us. Even for our Gift City products, you can directly reach out to us. We have our own website. So, you can reach out to your nearest Phillip Capital office. Of course, like I said, we don't have a very strong retail presence, so we have a few regional offices. So we've got a presence in Delhi, we've got a presence in Pune, and certain select cities. So investors can definitely reach out. Best source I would say is the internet, because you have our information publicly available. So you can definitely reach out, write to us, request an in-person meeting such as this one.
Yeah. So let me move to one of the fun questions. Like, given the market being at all-time new highs, and when clients are more keen into generating alpha, so that's what attract clients now. So why do you think an investor would shift towards ETF investing now?
Correct, correct. I think that's a very very valid question, because at a time where all as investors we are very very alpha seeking. So first I can tell you is that our strategy is an actively managed strategy. So we pick and choose ETFs. Anyone following us on maybe LinkedIn would know that we've not been a big fan of investing in China, for example. So we ours is an actively managed portfolio of passive instruments. That's number one. Now coming to your question that why would anyone actually come for ETF? So first is if you really look at a developed market in the US, the entire debate has been around active versus passive, where we've really seen that over the past so many years, a significant chunk of the fund managers have underperformed, the broader markets over a 15 to 20-year period. And I'm quoting the SPIVA report. More than 80%, 90% of the fund managers have underperformed the benchmark. And to that extent, ETF has become a very, very popular route, because ETF itself is a diversified basket of securities. One very important element, in fact, it is the answer to your question, is that ETF is a diversified basket of stocks. So the idiosyncratic stock specific risk in the portfolio gets largely eliminated. Markets are at an all time high. There are stocks at an all time high. But inside an ETF, not every stock could be at an all time high. In fact, there are certain thematic ETFs that we are tracking that continue to trade at considerable discount to their 2021 highs. So this is despite the kind of rally that we've seen in the year 2023. So there are some pockets of opportunity there as well. And these are some of the reasons why ETF can be a very 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 effective route, where investors can actually allocate to a particular investment theme, like for example only a basket of semiconductor stocks, or let's say only a basket of social media companies, for example. And thereby largely mitigate the risk of sudden downside, because in a year like 2022, for example, we've seen Facebook and Netflix undergo massive correction, despite they being some of the industry leaders. So all that risks can be largely mitigated. I'll not say they'll be completely eliminated, but surely mitigated to a great extent. So this is something that you can consider.
And one thing, like the tagline says, like investing in today's trends and tomorrow, which becomes tomorrow's ideas eventually. So, what kind of sectors do you see currently trending, and where is the potential scope?
Sure, sure. So again, I'll split this question into two parts, and I'll really split or break down our investment tagline. So trends of today is something that we are observing over the next 1 to 3 years, and then ideas of tomorrow are essentially something that we are observing as to what can happen after the next 3 years. And the next 3 years, a very critical event for us would essentially be the monetary policy of major central banks. Because right now, as we operate, interest rates across the globe have peaked. The argument is no longer around whether there will be more rate hikes. Of course, the US Federal Reserve has not completely rolled out. They keep on, keeping explaining it in slightly gray areas. But Now, the entire debate or the entire deliberation is around when will the rate cuts indeed happen. Now, whether there will be one rate cut this year or two rate cuts this year, but at least over the next 3 years, we can expect rate cuts across major central banks, especially because, let's say, in an economy like a Europe or UK, it is actually on the verge of a slowdown. They narrowly escaped recession, but that is, again, it's an economy slowdown. So the next 3 years would perhaps be characterized by falling interest rates. And because of falling interest rates, which are the sectors that can benefit? So perhaps technology on the small and mid cap size would benefit. Or we are looking at some rally in metals because a falling interest rate or a falling policy rate in the US would mean a weaker dollar, which we all know because even the rupee will appreciate. But a weaker dollar in general could actually pave the way for a rally in metals. So, everyone has already seen the kind of rally which other metals have also brought about. Copper has seen a very good rise. Silver miners have seen a very good rise. So those are some of the trends in the next two, let's say 1 to 3 years that we are very closely tracking. But now coming to what we really understand is the ideas of tomorrow. Again, this will be a very, very long drawn picture. Ideas of tomorrow essentially, we start with, what is the kind of world that we will be operating in, let's say, the next 5 to 7 years. So we are visualizing a world which is much more interconnected. So Internet of Things is something which will be a dominant feature. We are visualizing a world where artificial intelligence would have taken a much deeper root, across different businesses. So artificial intelligence would have significantly grown. Semiconductor chips would have become smaller and smaller, yet smarter and smarter. I think, that is the trend which is going on in semiconductor chips as well, especially when you look at the size of those chips. Sustainability is something that would attract increased focus. Climate change, you have a lot of ETFs around climate change, you have an ETFs around electric vehicles and things like those. So sustainability is something that will again be a very, very critical factor because, after 5 to 7 years, the entire world will be much more closer to their net zero emissions target. So actions would have been taken in that regard as well. So these are some of the themes that will dominate the next 5 to 7 years. But what we can also consider is the kind of infrastructure that will be needed to support these themes. Like, for example, if you really look at the kind of data that gets generated every single day, okay, especially because of something like the Internet of Things and interconnected world, so you would require a lot of data centers. So that is the infrastructure that we are coming at, or even the kind of electricity that will be required. So, again, areas like blockchain, Bitcoin mining, semiconductor manufacturing, or data centers, they would consume humongous amounts of electricity. So, those are again the kind of themes that we can expect to benefit. Water sustainability. On one side, we are, essentially, speaking about a potential scarcity of water. But a lot of these technology heavy industries also require huge amounts of fresh water. Okay, let's say something like semiconductor manufacturing. So that is again, water sustainability. In fact, we've invested in a water resources ETF, and that's done quite well for us. So these are some of the ideas of tomorrow, and that is something that we are again closely monitoring and then deciding our investments accordingly.
And when you spoke about metals, one of your newsletters had talked about this yellow metal and its traction. So do you want to talk about that here?
So are you talking about lithium or?
Yeah.
Acha. So lithium, yes. I mean, we had written a full-fledged newsletter on lithium, about a year back, actually. Lithium again has a lot of challenges. There are certain, the lithium is again is a part of the infrastructure that will support the electric vehicles. But lithium extraction is very, very challenging. Again, in lithium, we need to understand that there are something called as identified reserves, and then there are something called as proven reserves. So there is a huge difference between these two. Lithium reserves are getting discovered. We found lithium reserves in India as well. In Iran, there were certain discoveries. But out of the total globally known lithium reserves, only 20% of it is actually established for commercial extraction. And those centers or those pockets are the South American nations or Australia, for example. And again, lithium mining is very, very environmentally sensitive. There is a lot of regard that needs to be had for environmental considerations. So these are also the kind of challenges which can create a potential shortage of lithium, and that can be reflected in the returns of the lithium ETF also, perhaps in a few years' time.
So, for the benefit of the investors who have just joined, they missed the part of the taxation. So, I'll just take one question. If you could reiterate the answer, like to start off with, how does one get access to investing in these assets? What are the tax implications? So, this
Sure.
might answer most of the questions just following on.
Yeah, sure. So first is, a clarification that, all the tax benefits that everyone understands on Gift City. So these are tax benefits which are available for businesses which are setting up shop in Gift City. In certain cases, investors will get an exemption on taxation. But most of those benefits are actually for non-resident investors. For resident Indians, especially in our global PMS, so there will be a security level taxation. So the long-term taxation will, be charged at 20%, because these are, even though these are US listed ETFs, but these are not Indian securities, so they will be taxed as normal capital assets. So long-term capital gains will be taxed at 20%, and with the benefit of indexation. Short-term capital gains will be taxed at your regular rate of taxation. And for this reason alone, this is also one of the reasons why we are not frequently churning the portfolio. If we believe that there is certain value still that can be derived in the portfolio, then we might as well in the ETF. I'm sorry, then we might as well hold on to those ETFs. So we are very cognizant of this angle as well. For non-resident Indians, the view that we have from our consultants is that because this is income typically getting generated outside India, so this income will not be taxed in India. So non-residents will have to check with their local tax authorities.
In your one of your PPT, one of your slides in your PPT, you spoke about the capital appreciation. So, could you just elaborate on it? Like, what is the projected rate of capital appreciation for over next 1 to 3 years?
Right. So I think over a longer period of time, and again, this is not a guarantee of future returns. So this is a disclaimer loud and clear. Over a longer period of time, we are targeting an annual return of close to 12 to 14% on a CAGR basis, but in US dollar terms. These are returns which we believe are very, very reasonable. Of course, in the previous year, the returns were much more because of the kind of rally that we saw in the markets. A year before that, the returns were fairly volatile, but accounting for all those ups and downs, so 12 to 14% over a very long period of time is something that we can believe is reasonable for our investors.
So, I think that has answered a lot of the questions just following about the
Ouch.
performance as well.
Yeah.
So, of course, besides US market, are there any other developed markets that you look into for considering investing?
Sure, absolutely. Like I said, and maybe I'll just revisit this point, that while this is a portfolio which is investing in US listed ETFs, it does not necessarily mean that the fund is US focused. So today in our fund, roughly 60% of the investment allocation is directed towards US focused ETFs. But the remaining ones, we are looking at countries, so there are certain developed countries. So Japan is one country that we like. Taiwan is something that we are looking at. And of course, there are multi-region exposures also. Of course, now you did mention developed nations, but we are also seeing some trends across the developing markets as well. Suddenly, China has been doing very well, so that is something that we really cannot ignore. Very recently, some economies in South America did very well because of the kind of rally that we've seen in metals. European Union also, so there are select nations that have been doing quite well. So we are really observing them, and if we have a very strong reason to believe that this is the kind of rally that comes from a fundamental assumption which is expected to result in very, very sustained growth over a longer period of time, we might as well consider it as a part of our allocation as well. What we really need to realize is that the entire universe of US listed ETF alone gives us access or gives us a lot of choice, to allocate across different countries, different businesses, as I mentioned, in different regions as well. So, that really opens up a wider gamut of opportunities.
That before the next question, it's more like a follow-up. What is the difference between the ETF of various fund houses which are tracking the same index? Why are there so many in US, and how could you pick the right one for your product?
Absolutely. Again, a very, very valid question. I mean, just to give you a very interesting statistic, for example, semiconductors. Okay, now the largest semiconductor ETFs also. So there are almost six semiconductor ETFs, which are provided by different ETF manufacturers. So these ETFs differ from one another, of course, due to the kind of allocation that they have. Certain ETFs may have more of Nvidia, certain ETFs may have more of TSMC or ASML, for example. So the primary difference is, the kind of weights different companies hold in different ETFs belonging to the same theme, like for example semiconductor. So at our end, as part of our data capabilities, we also very critically evaluate, the top holdings across all ETFs. Because if we have to choose one semiconductor ETF out of six ETFs, why would we choose one particular ETF over the, let's say, the ETF of other manufacturer? So a lot also has to do with, the kind of ETF concentration. And we have a very, very elaborate data set which is giving us the top holdings across different ETFs. So, that is also helping us make a choice. In fact, this could be a question that could come later on as well. But, I'll just answer it here itself. I mean, if anyone has that question, that in our ETF, in our portfolio, we have roughly 15 to 20 ETFs. Now, one ETF can mathematically have 50 to 60 stocks, which means a 15 ETF portfolio can have anywhere between 750 to 800 stocks, for example. Mathematically speaking, this is a very, very diversified portfolio, and nobody can recommend a portfolio having 800 stocks. But a lot of these ETFs have, stocks which are common. Plus, there are certain ETFs which are very, very concentrated. Like we are tracking certain ETFs where the top two holdings constitute 44% of the total asset allocation. So for us, also it is important that what is the stock concentration of that ETF. In which particular ETF would we like to go for a fairly concentrated portfolio? Versus for which ETFs we think that okay, we would like to play this broader theme as a whole. Let's not risk it by having a very, very concentrated ETF. So again, that is a very, very active decision that our team takes. In fact, in our portfolio, the top three effective stock holdings are close to 9.5 to 10%. So that by no means is a very, very diversified portfolio. It is a fairly concentrated portfolio having high volume of or rather high allocation to some of the better performing companies which we believe will drive value, and all the others are very well diversified across different sectors. So I think that it is a very, very right mix of a portfolio allocation.
When you say that 50 to 20 ETFs in your thing, so how often do you take cash calls? Like, if you want to talk about the liquidity in the portfolio.
Correct. So of course, I mean honestly, because this is not a stock-based portfolio, so cash calls are very, very rare. If we really have a reason to believe that a particular theme has really, has delivered the value it should have delivered, and we are not finding or we are not ready with the next opportunity that we would like to invest in. So only in those very rare cases we could take a cash call. In our portfolios, we don't invest everything on day one. We really complete the investment cycle over at least a good 2 to 4 months on an average. Of course, the idea is not really to time the market, but this is a very, very disciplined approach to essentially invest over a longer period of time. In a bad year, like in a year like 2022, there were certain periods in which we completed the investment cycle over 6 months. And then there are certain investors who came in the second half of the year when the markets were really low. So there the investment cycle was completed in a very short period of time. So that is how slowly and steadily we are deploying cash. Wherever we think that the valuations are extremely reasonable, I think we would make more allocation. Once again, we would not call it timing the market, because at PhillipCapital, we very strongly believe that we are actually not good at timing the market. What really drives returns over a longer period of time is the discipline with which we are allocating and then monitoring the portfolios.
When given that it is a based approach, there are potential data deficiencies in our world. So how do you manage this data insufficiency risk?
No, no, absolutely. I think again a very, very critical, question that you've asked us. So again, we've segmented our data sources into different categories. There are certain data points which are available to us, where the data is available every single day. So, that is something that we monitor. There are certain macroeconomic indicators that get released every month. So even that is a fairly publicly available source of information. So our team is very, very diligent in updating that. Good part is that our analysts have also been developing a lot of APIs, using programming languages such as Python. So we've actually developed some in-house APIs that fetch data directly from publicly available sources. So that helps us. But certain areas where we really find difficulty are some of the industry-specific data. What we really call as a non-financial data. Let's say it could be something like a semiconductor supply chain pressure index, for example, or it could be, let's say, input manufacturing costs and other things. So those are not frequently available data sets. Our endeavor is to really look out for sources which have a very, very regular stream of data. A very nice news article which contains historical data is actually of no good to us. We would rather, go for official websites, and there we would look for data sources which are very, very regular. Now, they could be annual data points, they could be quarterly data points, or they could be monthly, weekly, or daily data points. So, that is how we've segmented this. But as you rightly pointed out, data sufficiency is indeed a risk, and our hunt is always for very, very alternative data sources, which could be good proxies or good estimates of the original data point.
And apart from this data risk, what are other risks do you think the portfolio would undergo?
So first is the sharp volatility in the market that really happens, that can activate a lot of behavioral biases. I think I always say this, and I'll say this again, that currently we operate in markets where, for example, the US Federal Reserve, the monetary policy action may not have such an impact on the markets as compared to what the Federal Reserve Chair is speaking. So there is a lot of sentiment-based, non-financial data, a lot of data points that people actually pick from the kind of speeches or the kind of tone which the Federal Reserve Chair is using. So this is just one example that I spoke about. But because of this, because of there is a lot of news flow. There is suddenly some geopolitical tensions. This year we have elections happening in so many countries globally. So again, that has the propensity to drive equity returns or at least have volatility over a very short period of time. So the biggest risk could be a very, very impulsive decision just because there is a short-term volatility. I'll give you my own personal experience. In a year like 2022, which was typically the first year of our fund, the fund actually witnessed a lot of volatility. But when the year ended, we actually outperformed our underlying benchmark by a very huge margin. Semiconductors, okay, which was one of the worst performing themes for us. Either we could have sold off semiconductors and then waited for the right opportunity, which we did not. We actually held on to semiconductors. Not only did semiconductors recover towards the latter part of the year, but in a year like 2023, a semiconductor ETF gave us more than 55 to 60% dollar returns. So, that is the kind of risk that we see, that we may have a very, very elaborate investment framework, a very, very elaborate investment discipline, but it is actually a volatile year. That is the true test of the investment discipline, that, how well we are sticking to our core philosophy. And I think that is precisely what we achieved in a year like 2022. So we have a track record for a bad year as well as a good year. And in both the years, we've outperformed the benchmark by a decent margin.
I got it. And moving on to the next is that one interesting question from Yesh. I don't know if you could answer this. I just want to ask this. If we want to open a corn trading business for self, would considering Gift City over UAE Special Economic Zone for zero taxation primarily be a reliable option as of now? I know it would be cheaper for domestic business to register in Gift City rather than UAE. but would it have a virtual office registration facility in GIFT City equivalent to what's UAE? So that we do not have to purchase or rent the office space and still enjoy the tax benefits of GIFT City.
So, I would say that my insights on these will be very, very limited. So, one point which I did not mention in the benefits of Gift City is, very rightly pointed out, the operational costs in Gift City are definitely lower. Virtual office, from what I understand right now, could not be a very good idea because the Gift City, the entire ecosystem, the entire infrastructure has been designed so that people actually set up their businesses and operate out of Gift City. There are provisions for a remote broker dealer, but again, that is something that needs a further deep dive. But right now, it is very, very difficult to comment on the entire concept of a virtual office because the entire thought behind Gift City is for businesses to actually set up here and have a physical presence where all the activities are carried out within the Gift City ecosystem. So I mean that is the only limited insight that I can offer. My apologies for this.
And one more question is that do you provide access to global markets to Indian investors to GIFT City, not with respect to investment in ETF, but also in stocks, commodities, derivatives, and other products?
So we are a registered broker dealer in Gift City. And we also have activated what is called as the global access, or what we call as the global markets access. So we have investors or clients who can set up trading accounts with us, and they can invest into other markets also. Currently, we have made only US markets available, and the investment products available are US stocks and US listed ETFs. For other products also, you can actually get in touch with our team. Wherever a customization is possible, we can definitely explore something. So I don't manage the broking business, so there is only so much I'll be able to. Yeah.
Yeah, I understood. Sorry to interrupt. Actually,
No, no, no. Please, please, please.
coming back to the product topic, there's always a currency fluctuations. Of course, you've taken it already, but just want to reiterate. Do you use any
Right.
hedging strategies to mitigate this risk?
First is, of course, I told you that ours is a US, like a portfolio investing in US listed ETFs. So to this limited extent, we are not providing any currency hedging. And automatically our endeavor would be to, achieve returns, which are actually superior net of, let's say, the dollar depreciation, if at all. So that's number one. Second is the universe of ETFs alone gives us certain investment options where country focused ETFs are hedged for currency risk. Not all of them, but there are certain countries like Japan, for example, which have a hedged Japan equity ETF. So there are certain other products, there are certain ETFs on the fixed income side which also have the element of currency hedging embedded within them. So that is how we are factoring in currency risk as well, because especially when we invest in a region like Japan, we cannot disregard the fact that the yen has witnessed the sharpest depreciation among the major economies. If you really see, so returns, the USD returns, if it is unhedged, the USD returns will actually not be very good as compared to returns which are giving a hedge against the Japanese currency. So we monitor these ETFs also very closely, and to that extent, we also monitor the currency markets, which in turn, at least in the short term, is a result of the monetary policy differentials between the nations. So that is how we are indirectly managing currency risk. We are not directly doing a currency hedging by way of, let's say, derivatives or stuff.
So it doesn't mean that every ETF will have it embedded.
Yes, right? Yes. So not every country-focused ETF will have a currency hedging. There are certain, very, very selected ones which are giving you that option.
And actually, a year ago, you in the interview, you just told about that, investing in US tech space for a long term, holds good. So, what is your view on it now?
So, of course, I mean, in the last 1 year, we've seen a significant rally in technology-based investments. And of course, thankfully, because we had also invested in those themes, so our investors were able to derive those kind of returns as well that we saw in the last year. So going forward, because we are operating in a high interest rate environment, If anyone wants to invest on the assumption that okay, there will be XYZ number of rate cuts this year, and hence I can derive an upside in technology. So we would advise very strong caution here. We would really want to consider a very, very long term picture, especially what we call as the ideas of tomorrow. It could be a very good idea to start allocating, for the purpose of long term investing. Given the current interest rate environment, we are very, very skeptical of investing in small and mid cap, technology companies. So themes which are, very, very high on fintech are something which we are closely monitoring, because these are the themes which witnessed quite a lot of correction in 2022 as well. Certain themes in technology continue to remain like favorable for us. So semiconductors and all those, let's say something like a cloud computing. So again, we are leaning towards the large cap side of those companies. Mid and small cap is something that because of the kind of interest costs these companies may have. We are and the kind of valuation drops that can happen if there is, let's say, volatility on the interest rate side. So that is something that we are very, very critically evaluating, leaning towards the large cap side. But best approach, I think, across markets, across time frames is that invest for a longer period of time. And I think that can better achieve investment objectives over a longer period of time.
That's true.
Yes.
So, with the benefit of time, let me take a few questions. How quick is the timeline for the resident or non-resident investor to get onboarded by a Gift City fund? Is there any hassle to investor, like coming down to the Gift City and do it, or do it virtually?
Oh, so the thing is that our our representative is across our different offices in India or even in the Middle East, so they can facilitate the account opening process fairly seamlessly. Like I said, the account opening is slightly more seamless because there is no requirement of bank account. The KYC process and the other checks and balances will remain. So that is to that extent the process. When I say seamless, there is also a lot of familiarity. It is not significantly different from, let's say, registering with an India focused or an India based PMS. So you can expect similar timelines. We typically take about a week to complete the onboarding process. Assuming all the documents and everything is in place.
This the question we asked now has already been answered, but still, like, if you want to add few points to it, like, of
Yeah,
course,
yeah, sure.
how do you see the Indian markets to be valued in this current rally? And do you really think that investors should consider, investing in other jurisdictions when domestic countries doing good?
So, I think I'll just reiterate a few points. As you said, that the debate for us is never about which market is better or worse than India. Indian markets, okay, we are expected to be the third largest economy. Our stock market is expected to be one of the largest in the next 7, 8 years. So definitely there is considerable merit of having an India focused long only portfolio. Our submission remains the same, that while we recognize that the India growth story indeed can derive a lot of value to investors, there are pockets of opportunities which the Indian markets may not be able to provide today. I mean, I have gone on record and said this, that India hosts some of the sharpest and the brightest scientific minds globally. But the kind of infrastructure that is needed may come to us perhaps in another decade's time. So if you have the opportunity to invest and derive some upside from trends which are emerging in other parts of the world, so why not go for it? So that is, I think, the assumption, and I mean that is the submission. I'm sorry. Yeah.
To keep, of course, we have come to the end of the session, but of course, a lot of questions are pouring onto the podium. Let me take
Great.
it a bit later, but let us know a bit, Canada, about yourself. Like, we learned that you love traveling, trekking, photography, and also you're interested in cooking. Apart from, of course, apart from fund management.
Yes, yes, I do. Yes.
And let's keep this as a mind over money session. So,
Mind over money session.
how do you see this, and how has this influenced your professional life?
So, first is, of course, hobbies are a very, very great way to unwind. But, you did mention traveling. So, traveling, of course, really gives us a lot of perspective, especially because I'm a global fund manager. If I have visited a particular country and then I'm reading about that country in the context of a portfolio decision, I think the insights are much more richer. If not anything else, you get an opportunity to interact with local business owners and, just in general try to understand, how things are there. So that really adds a lot of value to the kind of work that we do over here. Trekking, of course, is something that I do. I think trekking is my source of, inner peace. Again, inner peace is a very big thing. But yes, it really keeps me very, very calm, especially in a profession like ours, where there is a lot of information, there is a lot of data, there is lots to process and lots to filter out as well. So I think when I say about a very, very focused and a very, very disciplined approach to investment decision making, I believe that having such a disciplined approach, especially during volatile markets, requires a significant degree of calmness. And I think trekking takes me closer to that calmness. So I'll not say that I am 100% calm. Every once in a while, everyone is subject to behavioral biases, but at least an activity which takes us close to nature brings us closer to this kind of calmness as well. Photography is, again, I think it's an expression of art. So it's that creative pursuit. Cooking again. I think photography. I don't know. I mean, it would be perhaps an eye for detail because I am very, very particular about in the kind of photos I take. I don't click. I am more focused on, let's say, photography of different buildings because I love places with a blend of history and architecture. So photography is also about choice. I just don't click anything and everything that I find attractive. But it really again helps in decision making, especially when it comes to making a choice. Cooking again, it has a special place, but cooking is again, there is a certain process to it. Cooking is something honestly that I like. Honestly, I was not expecting this question that how it will really translate into in my profession. But I think cooking again brings a lot of method to it. Cooking is again very, very creative. Cooking also entails some bit of experimentation. So I think these are things that can very well help when we are sitting on the study table. I mean, we call it a study table approach where we are brainstorming different investment ideas. There are a couple of other hobbies also which I have. So one is of course I really believe in the power of journaling. So every day when I wake up in the morning, I write one page in my diary. Just write down my thoughts. It helps me clear my mind. Reflect on certain things. And the last hobby or the last activity is, I think, the one that you mentioned that I do write a lot of newsletters. So every month, we've been writing newsletters. We come up with a note every week. I write articles for the CFA Society as well. Of course, these are articles and these are writings on the financial markets only. But I think these are pursuits which I really pursue as a hobby which is very, very well integrated into the work that we do. And that, of course, really adds a lot of value because the more we write, the more we research and vice versa. And the more perspectives that there are with the entire team as a whole.
Yeah, thank you. Of course, along with the fun, we got to know more about the fund manager as well.
Yes, yes. Thank you. Thank you so much.
Before we could end the session, so what kind of a message that you want to give to the investors who are bit skeptical to invest in current market level? The message perhaps remains the same that which I had given a year back when we spoke to you. It is that always have a very, very long term focus. Again, during good or bad times, this is the same thing which everyone will say. Having a long term focus, having a very, very patient approach to investing is very, very boring. But I think if we really look at across timeline, the most successful investors globally have had this one approach, which is staying invested in the long term. Personally, I feel that this approach also gives you a lot of breathing space. You are not affected too much by market volatility. You are really focused on investing, with a very clear objective in mind, objective which you wish to realize over a longer period of time. So that is something which I think is the clear message.
I would say that, read as much as possible, because, the more you read, different books, different articles, I think the more perspectives are unlocked. Different points of view become available to you, and that is something that you can factor in your decision making as well. So I think these are the two messages that I can give to investors.
Thank you. So with that, we've come to the end of the session. And thank you for enlightening us on a Friday evening, sir. Thank you for that.
Thank you so much. I think there is a reason why I kept my PPT very short, because I wanted, to have more of Q&A. Firstly, thank you so much for these questions. I think the kind of questions that came in really make me believe that the message that we really want to convey has been indeed conveyed. And I think, as a closing remark, I can only say this. The title is that the Indian investor goes global. So today, the Indian investor is very well equipped, to invest in a global portfolio, because what we believe is that the Indian investor is very well informed about the global market. There is a lot of curiosity because investors are tracking global markets. I think everyone in this forum knows who Jerome Powell is. So that itself shows that everyone understands the integration across different markets, and that leads them to different avenues that can enable them to indeed invest in the global markets. And that is how, let's say, a firm such as ourselves comes into the picture. So, we are the ones who will enable you to facilitate your global investments, and in this process enable you to achieve your investment objectives.
With that, we've come to the end of the session, sir. Thank you. Thank you for being part of it.
Thank you.